Welcome to Mayor Brown's Global Financial Markets Podcast. Each 30-minute episode is designed to help listeners better understand the legal issues that impact their business given the ongoing uncertainties in the financial markets worldwide. Speakers from across Mayor Brown's practices and offices provide their timely insights on a wide range of topics, including finance, financial services, and insurance regulatory developments, securitizations, and litigation in the United States, the United Kingdom, Europe, and Asia. We hope you enjoy the program.
Hello, listeners. Our topic today is how capital markets may be affected by the U.S. Basel Endgame Proposal. My name is Matt Bisanz, and I'm a bank regulatory partner in Mayor Brown's Washington, D.C. office. You may have heard me on our prior iteration of this podcast that addressed the overview of the Basel Endgame Proposal, and today we're going to focus on the capital markets implications of it, and quite appropriately for that, joining me is my fellow partner, Anna Pinedo. She is a corporate and securities lawyer in the firm's New York office. And with that, I'll give a very brief background, but again, I would commend you to listen to our prior version of the podcast, look at our alerts on our website that they go into great detail on the overall implications of it, because today we're just focused on the capital markets pieces. As many know, in late July, the U.S. banking regulators proposed changes to the U.S. regulatory capital rules. The changes would be wide-ranging, affecting all parts of the rules, from credit to market to operational risk. They would affect the 40 to 50 largest banks in the U.S., and Anna will give some more details, so I won't steal any of her thunder. Turning it over to you, Anna.
Thanks, Matt. So, as Matt said, the proposals, if they were to be adopted in their present form, would effectively increase the need for capital, and they would do so in a variety of different ways. In part by increasing risk-weighted assets, and you can think about that as the denominator of risk-based capital ratios, by approximately 20% in the aggregate across affected banking organizations at the holding company level. Parts of the proposals also would affect components of regulatory capital. Now, that's the numerator of risk-based and leverage capital ratios. The agencies used some 2021 data in order to make estimates. Based on those estimates, the agencies calculated that there were a few large banking organizations that had less capital or would experience a capital shortfall if the proposals were to be adopted in their current form. Without naming them, they said that 5 holding companies had less common equity Tier 1 capital than the proposal estimates would be required, and therefore those entities would need to increase their capital ratios between 16 and 105 basis points. Other holding companies would have had sufficient levels of common equity Tier 1 capital. It also says that there were at least 3 U.S. GSIBs, global systemically important banks, that would have had a moderate shortfall in required TLAC. So the proposal does overall not result in a capital neutral solution. Originally, when regulators had discussed these proposals, they had suggested that they would come up with an approach that was capital neutral. However, upon the release of the NPR, it's quite evident that these proposals are not capital neutral and that capital requirements will increase fairly substantially in some instances. In fact, the capital requirements would increase substantially for trading activities. The Fed memo itself estimates that capital requirements would more than double for certain firms, particularly because of their trading activities. There's a large increase in risk-weighted assets for market risk overall, and that would require that large U.S. banks assess all of their activities in this area. That might mean as a reaction that some large U.S. banks might, for example, choose to conduct their business differently and might result in a decline in liquidity in certain markets, or that certain banks might choose to move away from certain activities, and that some activities might move into the shadow banking sector. In addition, as I'm going to discuss in a moment, there would be an increase in capital required for operational and for market risks. That also would be new for certain categories of banks. So now I'm going to get into a couple of specifics. I'm going to start by discussing the AOCI opt-out election. So subject to a phase-in period, Category 3 and Category 4 banking organizations. So these are non-GSIBs with $100 billion to $700 billion in total consolidated assets and less than $75 billion in cross-jurisdictional activities, would no longer be permitted to opt out of including certain components of accumulated other comprehensive income, AOCI, and regulatory capital. So what's the consequence of this? The consequence is that unrealized gains and losses on available for sale debt securities would flow through regulatory capital ratios for these banking organizations. Obviously, this is going to impact different institutions differently. Category 3 and Category 4 banks are going to have a phase-in period for including AOCI components in Common Equity Tier 1. The phase-in period in the proposal would run from July 1, 2025 to June 30, 2028. And then all components would be required to be included or reflected by July 1, 2028. So what's the net effect of this? The effect of this would be that it would increase capital requirements for lending activity generally. Obviously, as I mentioned, different banks would be affected differently, but overall, it would have the impact of increasing capital requirements. Now I will go through a different aspect of the proposals, the expanded risk-based capital approach. Under the proposal, banking organizations with total consolidated assets of $100 billion or more, including U.S. intermediate holding companies and the depository subsidiaries of bank holding companies with $100 billion or more in total consolidated assets, would be required to calculate capital requirements using the revised credit risk, equity risk, operational risk, CVA risk, and market risk requirements implementing the revised Basel Committee standard, the expanded risk-based approach. So the expanded risk-based approach generally replaces models-based approaches. Category 1 through Category 4 banks would calculate market risk capital requirements under the new market risk standard. This includes a standardized measure and then, subject to supervisory approval, a models-based approach. So let's talk about output floors. First, a banking organization with $100 billion or more would calculate risk-based capital ratios under the standardized approach and revised credit risk, equity risk, CVA risk, and market risk requirements under the expanded risk-based approach to address the Collins Amendment. The Collins Amendment, you may remember, was adopted as a result of the Dodd-Frank Act. The calculation of risk-weighted assets under the expanded risk-based approach is subject to an output floor of 72.5% of a banking organization's aggregate risk-weighted assets calculated based on the approaches for credit risk, equity risk, operational risk, and the standardized measure for market risk. The output floor then is compared to the banking organization's aggregate risk-weighted assets calculated based on the approach for credit risk, equity risk, operational risk, and market risk. Under the Basel Committee standard, a banking organization's risk-weighted assets are equal to the higher of total risk-weighted assets calculated using the approaches the banking organization has and supervisory approval to use in 72.5% of total risk-weighted assets calculated under only the standardized approach with respect to credit risk, counterparty credit risk, CVA risk, securitizations, market risk, and operational risk. As a result, the banking organization's risk-based capital ratios would be the lower of each ratio. Obviously, this also will have a negative impact on capital requirements. So, yet another issue for banks to consider. Now, if we turn to another aspect of the proposals, deductions and minority interests. Currently, Category 1 and Category 2 banks are subject to different requirements than Category 3 and Category 4 banks. For example, Category 1 and 2 banks deduct from Common Equity Tier 1 mortgage servicing assets, temporary differences in deferred tax assets, and significant assets in the capital of unconsolidated financial institutions. Under the proposal, Category 3 and Category 4 banks will be subject to these deductions from regulatory capital that currently only apply to Category 1 and 2 banking organizations. In addition, Category 3 and 4 banks will be subject to the stricter minority interest limitations that apply now only to Category 1 and 2 banks. So I'll also comment a little bit on credit risk. As I mentioned at the outset, banks will not be permitted to use internal models to calculate credit risk capital requirements. Categories 1 through Category 4 banks would also calculate credit risk capital requirements using the expanded risk-based approach. I'm just going to touch on a handful of things for illustrative purposes. So, for example, in the context of investment-grade corporate exposures, for a corporate exposure to be eligible for a lower risk weight applicable to investment-grade corporate exposures, the company or the parent must have securities traded on an exchange. So, what does that mean from a practical perspective? There's a 65% risk weight applicable to a corporate exposure to an investment-grade corporate. In all other cases, there's 100% risk weight applied. So that's a pretty significant difference. If you look at a different category that's getting a different asset class that's getting quite a bit of attention under the proposals, the way that U.S. banking agencies are handling residential real estate exposures and the risk weights are quite different and higher than how our European counterparts are handling risk weights for residential real estate assets, higher than our European counterparts. We'll have a separate presentation, separate podcast on mortgage and securitization related issues presented under the proposals. But this too will cause banks to have to reevaluate their businesses. In addition, exposures to small businesses, securities firms, and banking organizations will be different. The proposal would not adopt reduced credit risk capital requirements for exposures to small businesses, securities firms, and other non-bank financial institutions or highly capitalized banking organizations, or for short-term exposures to banking organizations. Finally, the last topic that I'm going to cover is operational risk. Currently, capital requirements for operational risk apply only to Category 1 and 2 banks and only for purposes of advanced approaches, risk-weighted assets. Under the proposal, Category 1 through Category 4 banking organizations would be required to calculate capital requirements for operational risk for purposes of risk-weighted assets calculated under the expanded risk-based approach. This is obviously not only going to affect capital, but going to affect many other aspects of a bank's business. there will be an internal loss multiplier for operational risk capital. This is going to be based on the proposal floored at 1. However, in another difference from the approach taken by other regulators, implementing authorities in other jurisdictions have set the internal loss multiplier at equal to 1 instead of at floored at 1. There's also an important issue relating to market risk. Banking organizations with trading assets plus trading liabilities in the aggregate equal to 10% or more of total assets, or at least $1 billion, are currently required to calculate market capital requirements under the U.S. capital rules. Going forward, Category 1 through Category 4 banks would be required to calculate market risk capital requirements. This means that capital requirements primarily attributable or affecting trading activities would increase quite substantially. So this will, again, result in many banks having to make difficult choices regarding certain business lines. All told, and while I've only provided snippets of some of the ways in which the proposals would affect banks' capital considerations, you can tell from this very, very brief summary discussion, and we refer you to our more detailed memo that summarizes the proposals for a more in-depth discussion. It's clear that the proposals are anything but capital neutral. The proposals also reflect an underlying bias or underlying preference for banks raising common equity tier 1 over more complex instruments. We've seen this regulatory preference for common equity tier 1 or simpler instruments for some time now, since the financial crisis. And this proposal, if anything, only serves to accentuate that bias for higher capital requirements and more of an emphasis on common equity tier 1 as a source of strength for banking organizations. Matt, I'll turn it back to you.
Thank you, Anna. That was a great walkthrough of the capital markets implications. As you were talking, I had a few items I just wanted to tack on that I've been thinking about. With respect to credit risk, as Anna said, there's going to be a whole new regime of risk weights for items like residential mortgages that we'll talk more about in another program, things like equity exposures. But one that I think has not been getting enough focus is past due or defaulted exposures. That right now, if something is, if a bank has a past due exposure to, say, a corporate, it has to risk weight that exposure to 150%, which is a fairly punitive risk weight. Going forward, a bank will need to assign a defaulted or past due exposure risk weight to any corporate borrower who has any defaults. And so I could be a corporate borrower and I could have a default to a completely different bank, even a non-bank lender, and the bank that we're talking about would be expected to assign me a punitive risk weight, even if I'm performing, even if my loan from the bank is well secured. And so that, I think, that this cross guarantee or cross default issue has not gotten a lot of attention and probably deserves it, because it will affect some of the more complicated corporate structures. Plenty of organizations have many banks they deal with, many lenders they deal with, and having to track or represent this could impede some activities. The other one I'll mention that is getting a lot of attention is the increase in risk weight for subordinated debt. That this is a popular capital raising device out there, and if banks were to invest in it, it would be assigned a higher risk weight than a regular loan from so regular bond purchase or regular loan from a corporate client. The third topic I'll touch on is moving what Anna said about the trading requirements. And I think the interesting thing that we're seeing on the trading or market risk requirements is with this idea of the boundary between the banking book and the trading book, and when something moves from a credit exposure in the banking book to a market exposure in the trading book. And a lot of this is accounting driven, but I think historically the people on the business side have not paid as much attention to the different capital treatment that will apply depending on which book something is booked in, and an instrument is booked in. And there will be a lot of attention going forward, because if a bank is required to perform the elaborate market risk calculations that Anna described, that might be a disincentive to make some exposures that would be in the trading book, say equities that might become listed equity exposures. Finally, and the last item I'll touch on is that there are going to be new minimum haircut floors for certain types of repos and securities financing transactions. We have not quantified the impact of it, but I think it's been receiving a fair bit of press because, like the operational risk items, this is an area where margins tend to be thin. They are a high volume, fast moving type of transaction. And so putting in place these minimum haircuts on securities financing transactions may impede some of the types of cash management and other short-term funding that the corporate sector might rely on. As you can tell from this, there are a lot of moving parts. These are just some of the areas we think are most interesting for capital markets transactions. I would encourage you, though, to stay tuned to later podcasts that we will have ones on mortgage, on fund finance, on investment management, and even as we speak, we are getting ready because earlier in the week, the FDIC Chair Grunberg gave a speech where he foreshadowed that there will be a long-term debt proposal coming out soon that will require these mid-sized banks, the 100 to 700 billion category that we've been talking about, particularly the U.S. versions of those banking organizations, to issue eligible long-term debt as a further absorbing capacity for losses. This is expected to be fairly significant for these banks, some of whom are less engaged in the capital markets. There are even some that are privately controlled in that segment, or that engage in fairly limited fundraising activities because of their structures. And so these organizations will need to comply with a long-term debt requirement under an impending proposal, which we will, of course, be covering in a client alert and a webinar. But for today, thank you for tuning in. Stay tuned for more to come. Anna and I appreciate you listening to this podcast, and have a great day.
We hope you enjoyed this program. You can subscribe on all major podcasting platforms. To learn about other Mayer Brown audio programming, visit mayerbrown.com/podcasts. Thanks for listening.